April 10th, 2024, Brussels, Belgium. Behind closed doors, the finance ministers of the G7 gather for a meeting that will never be broadcast, never voted on, and barely remembered by the public. On the agenda is a single question. What do we do with Russia's frozen reserves? Since February 2022, roughly $300 billion belonging to the Russian central bank has been locked away by the West. Not seized, not confiscated, frozen. The money sits quietly inside accounts at Euroclear in Belgium, the New York Federal Reserve, the Bank of England, and several European central banks. For 2 years, that money has been leverage, an unspoken deal. End the war, and your money comes back. But by early 2024, the war is dragging into its third year. Ukraine is running out of cash. U.S. Congress is gridlocked. European voters are exhausted. Something has to give. Inside that room in Brussels, the decision is made. Not to seize the $300 billion outright. That would look too extreme. Instead, the G7 chooses something more elegant. They will seize the interest. Those frozen reserves generate roughly $3 billion per year. That interest will be redirected to Ukraine. On April 30th, 2024, the announcement goes public. Headlines celebrated as justice, as accountability, as a clever workaround. Russia's money will rebuild Ukraine. But while Western media applauds, a very different conversation begins elsewhere. In Beijing, in Riyadh, in New Delhi, in Abu Dhabi, in Brasilia, central bank governors ask their teams a single chilling question. If they can do this to Russia, can they do it to us? The answer is obvious. Yes. If the West can freeze $300 billion for political reasons and then redirect the income from those assets to fund a war against the owner, then any country holding reserves in dollars, euros, or pounds is exposed. Your sovereign wealth is only sovereign until it isn't, quietly, without press releases, without headlines. Central banks begin acting. They don't panic. They don't dump everything at once. They do something far more dangerous. They begin selling used Treasury bonds, slowly, deliberately, month after month. By December 2024, just 8 months after the G7 decision, foreign holdings of U.S. Treasuries have fallen by $400 billion. China sells $89 billion. Japan sells $95 billion. Saudi Arabia sells $32 billion. This isn't routine portfolio rebalancing. This isn't profit-taking. This is a strategic retreat from the asset that once sat at the center of the global financial system. And it was triggered by one realization. If U.S. Treasuries can be weaponized, they are no longer safe. And when the world stops trusting the safe asset, everything begins to break. Because this story isn't about Russia. Russia lost $300 billion. The real damage is to the United States. By weaponizing the Treasury market, America damaged the single advantage that made its global power possible. The ability to borrow unlimited amounts of money at low interest rates because the world trusted used debt above all else. That trust has been cracked, and once trust is gone, it never fully returns. To understand why this matters, you need to understand what the U.S. Treasury market was. Before February 2022, it was the deepest, most liquid, most trusted financial market on earth. Total U.S. government debt held by the public, $24 trillion. Foreign countries owned about $7.6 trillion, roughly 30% of the market. China held $1.1 trillion. Japan held $1.3 trillion. This wasn't reckless behavior. It was rational. Countries earned dollars through trade surpluses and needed somewhere safe to store them. U.S. Treasuries were liquid, reliable, and most importantly, above politics. Yes, the U.S. had frozen assets before. Cuba, Iran, North Korea, Libya, Venezuela. that those were small, isolated states, openly hostile, already sanctioned, already outside the system. The rule everyone understood was simple. If you were a normal country with working relations, your reserves were untouchable. That implicit guarantee was the foundation of dollar dominance. It allowed the United States to run massive deficits without consequence, to borrow endlessly at low rates, to fund wars, welfare states, and consumption far beyond production. This was the so-called exorbitant privilege. Then came February 24, 2022. Russia invades Ukraine. Within 72 hours, the West freezes Russian central bank reserves. Roughly $300 billion, about $100 billion at Euroclear, another $100 billion at the New York Fed, around $50 billion at the Bank of England. The rest scattered across Europe. This wasn't unprecedented because of asset freezes. It was unprecedented because of who was frozen. Russia wasn't a rogue microstate. It was the 11th largest economy on Earth, a major energy exporter, a permanent UN Security Council member. And critically, Russia had deliberately diversified into Western currencies because it believed they were safe. They weren't. Every central bank noticed. Publicly, there was silence. Privately, emergency meetings. The question was brutally simple. How much of our reserves could be frozen if we fell out of favor? For China, the answer was terrifying. Total reserves, $3.4 trillion. Over $1.5 trillion exposed to dollar assets. For Saudi Arabia, $120 billion in treasuries. For Taiwan, $240 billion. For South Korea, $170 billion. The realization hit all at once. These weren't reserves. They were hostages. But central banks moved slowly. They hoped the freeze was temporary, that once the war ended, the old rules would return. That hope died on April 30th, 2024, when the G7 announced it would use Russian assets, not just freeze them. Use them. The legal justification was clever, but meaningless. We're not taking the principle, only the interest. From a central banker's perspective, that distinction is irrelevant. If you own an asset and someone takes the income it produces, you do not control it. That announcement crossed a line. It signaled that reserves could be confiscated for political reasons, and the selling accelerated. The data is public. From April to December 2024, foreign holdings of U.S. Treasuries fell $400 billion. China sold $120 billion. Japan sold $100 billion. Saudi Arabia cut holdings by 33%. Belgium, a proxy for Middle Eastern money, sold $25 billion. The Cayman Islands, often Chinese institutional capital, sold $18 billion. This was the largest sustained foreign selling of treasuries in modern history outside a financial crisis. And it was done carefully. Because central banks don't dump. They bleed out. And here's the problem. When foreigners stop buying treasuries, someone else has to step in. There are only four possible buyers: domestic institutions, domestic households, foreign private investors, the Federal Reserve. Domestic institutions already hold $6 trillion. They can't absorb trillions more without blowing up pensions. Households hold about $3 trillion and aren't increasing exposure. Foreign private investors face the same political risk as central banks. That leaves one buyer, the Federal Reserve, which means the central bank becomes the market. And when the central bank is the buyer of last resort, the market has already failed. This is where the system turns on itself. When foreign central banks were buyers, the math worked. The U.S. Treasury issued debt. Foreign governments absorbed roughly 30% of new issuance. Yields stayed low. Confidence stayed high. But once foreign buyers become sellers, the entire structure collapses inward. Because someone still has to buy the debt. And increasingly, That buyer is the Federal Reserve. By early 2024, the Fed held about $5 trillion in Treasuries. By the end of the year, it held $5.2 trillion. Officially, the Fed claimed it was shrinking its balance sheet. In reality, it was quietly absorbing the selling. Why? Because if the Fed doesn't buy, yields spike. If yields spike, interest costs explode. And if interest costs explode, the U.S. government enters a fiscal crisis. This is called debt monetization. The central bank prints money to buy government bonds. It's how every currency collapse begins. Weimar Germany, Zimbabwe, Venezuela, not overnight, gradually. And now the math turns lethal. The U.S. runs $2 trillion annual deficits. Total borrowing needs exceed $7 trillion per year once refinancing is included. Before 2022, foreign buyers absorbed $600 billion. Domestic buyers $1 trillion. The Fed $400 billion. After April 2024, foreign buyers are selling $400 to $800 billion per year. Domestic buyers are tapped out. The Fed must cover the gap. That's a $1 trillion swing. The Fed is now effectively buying the majority of net new issuance, which means the Fed is the Treasury market. And when the central bank becomes the market, trust disappears. Printing money creates inflation. Inflation erodes bond value. Bondholders sell. The Fed buys more. More money is printed. This is the death spiral. Meanwhile, the rest of the world is moving. Where are central banks buying instead? Gold. In 2024, central banks bought over 1,000 tons for the third consecutive year, the highest sustained accumulation since the 1970s. China officially bought 225 tons. Unofficially, likely double that. India, Turkey, Poland all followed. Why gold? Because gold can't be frozen. Russia's gold, held inside Russia, was never touched. Every central bank learned the lesson. They are also diversifying into commodities, non-dollar trade settlement, regional payment systems, local currency swaps. The dollar's share of global reserves has already fallen from 71% in 1999 to 58% today. That decline is accelerating. This doesn't end in a dramatic overnight collapse. It ends in erosion. Over the next 15 to 20 years, Treasury auctions struggle. Yields rise to 6 to 8%. Interest costs consume tax revenue. The Fed prints more. Inflation becomes structural by the 2030s. The dollar is still used, but no longer dominant, no longer trusted, no longer privileged, and once reserve status is lost, it never returns. History proves this. In 1914, Britain weaponized finance by seizing German assets. Neutral nations watched. They diversified away from the pound. It took decades, but the empire never recovered. The U.S. repeated the mistake. First in February 2022, by freezing Russia's reserves. Then fatally, in April 2024, by using them. The U.S. gained $300 billion. But it shattered the trust supporting $7.8 trillion in foreign treasury holdings. That's a 26-to-1 loss. This wasn't about punishing Russia. It was about revealing a truth the world can never unsee. U.S. Treasuries are political weapons. And once the safe asset is no longer safe, the system built on it begins to die. Slowly, predictably, mathematically. The free lunch is over. And the clock started ticking the moment they touched Russia's money.